Is a 50-year fixed-rate mortgage what American families actually need? Well, according to the Trump administration, it will be a complete game changer. But is it?
I don't necessarily think a 50-year mortgage is good or bad for home buyers.
I spoke with Dr. Daryl Fairweather, who is the chief economist at Redfin and studies the U.S. housing market.
I have a feeling that most people will find that the 50-year mortgage does not make sense for them, because when you're comparing a 30-year mortgage to a 50-year mortgage, the 50-year mortgage is going to come with a higher interest rate.
There's no doubt a 50-year loan is a huge leap from the default 30-year mortgage that most Americans have relied on for nearly a century. The 30-year mortgage is a product of the 1930s. Before that, many Americans took out short, 5-year balloon mortgages. Borrowers would make little monthly payments and pay a lump sum at the end of the term or refinance them. That system held up until the Great Depression. Suddenly, people lost jobs, refinancing failed, and home foreclosures swept the country. As part of its New Deal, the Roosevelt administration took a drastic step and jumped into the mortgage market. It created the Home Owners Loan Corporation to purchase defaulted private mortgages and repackage them into longer-term fixed-rate loans. The 30-year mortgage started getting traction because it made monthly payments much more affordable and lenders carried less risk. So, will 50-year mortgages actually help first-time home buyers in a tough house market?
The monthly savings might not be all that much. It might be like $100, maybe even less, that the typical home buyer is saving when they go from a 30-year to a 50-year mortgage in terms of their monthly payment. But they will end up paying much more in terms of their interest.
But how much more? Let's do some quick math. Today, a homebuyer takes out a 30-year mortgage of $400,000 with a fixed 6.4% interest rate. They will pay around $2,500 each month and $900,000 in total over the next 30 years. If it's a 50-year mortgage, the monthly payments drops to around $2,200, but the total balloons to over $1.3 million. And with a term that long, borrowers could spend even more years just to paying down interest rather than building equity. And there's the question of refinancing.
So for many people, they don't keep their mortgage for the entire length. They either move or they refinance. When we ran the numbers, it was something like half as much equity you would have after 10 years in a 50-year mortgage compared to a 30-year mortgage. And that means if they go to purchase their next home, they're not going to have as much money to put towards that next home. So even if somebody isn't planning on keeping the home for the full term of the mortgage, the term of the mortgage definitely impacts how much money they will have when they go to sell it.
For now, it's unclear when or whether the 50-year mortgage will be rolled out, but it will likely require new legislation. After the 2009 financial crisis, mortgages longer than 30 years are not currently considered qualified by the government. Without this backup, fewer lenders will be comfortable to issue anything longer than 30 years. At the end of the day, 50-year mortgages probably won't fix the root cause why so many Americans are now struggling to get their first homes.
There's a lack of supply. And the 50-year mortgage, it might be attractive to some people and get some people into the housing market who otherwise wouldn't be there. But that just increases demand and doesn't at all address the underlying supply problems. If you decide that you can afford it, now is actually a pretty good time to buy because it is a buyer's market. There are about 500,000 more homes for sale than there are buyers in the market, which means you have a better ability to negotiate down the price. It's not the best idea to try to time the market. I think you want to time your own personal life and your own personal goals.